Hey everyone, welcome to the show. This is the Paradigm Show where we talk about what's going on in the markets, and we take a deeper dive into macro and microstructure. So today we have David with us, who is our resident. What would you call yourself, David? Master of macro?
I think someone calls me Macro Man Randy Savage or something like that. But yeah, let's call me Macro Man.
I actually like that. Macro Man Randy Savage. That's amazing. And we also have Joe with us. Joe, you can go ahead and introduce yourself.
Yeah, so I work on the institutional coverage team in the US, and I'm more kind of like the boots on the ground in terms of actively trading with our customers and kind of give some color around the flows and the vol parameters and things like that.
But you need a cool nickname. So we have to.
You didn't prepare me for this. I don't know the flow guy.
We'll come up with a cool nickname for you. Let's go over the macro stuff. So David, what are you seeing in the markets right now? And just give us your take on that.
Yeah, I mean, I've been talking, I guess, for a few weeks now that I kind of feel that we're witnessing quite a significant underlying shift in the macro sort of dynamic that's been driving us over the last year or so. So obviously the story from the macro point of view has been the Fed hike cycle, and it's been obviously the most aggressive hike cycle that we've seen in recorded history. And that's obviously devastated, the stocks. In fact, nearly every asset class has been absolutely obliterated. And obviously crypto being a high beta asset class is not immune from that. So we can't ever talk about crypto without thinking about the macro. But I think we're seeing a significant shift in terms of we're now starting to price the end of that hike cycle. And there's a lot of time being spent talking around whether we're seeing a pause or a pivot, and people sort of pushing back on that idea, because we know we're going to see probably another 50 bips of hikes in December, and maybe that followed up with another 50. But I kind of think what's important for markets always is the direction of travel and also rates of change. And it's clear, so we're going to step down the pace of hikes in December from 75 bips to 50. So that rate of change is slowing, and then we're moving towards the pause. So we're now gone from spending a year essentially pricing this rate hike cycle, which has seen bonds sell off, yields go higher, which has seen the dollar rally super strong, and that kind of dollar wrecking ball that everyone talks about, which is kind of sucking liquidity out of every sort of corner of the world, really strangling global growth and then also crippling assets. We're now starting to see that kind of process come to an end. So what's really interesting to me is looking at, again, if we just look at rates and the dollar, we've broken some pretty significant trend levels. So we're seeing yields sort of come a lot lower and break some trend levels. And we're also seeing the dollar start to roll over. And I think the dollar is particularly interesting in all of this in the sense that I think FX is probably the asset class that kind of sniffs out a change in regime, probably better than any other asset class, because we know even if we get a pause, rates are going to stay there, so you won't see front end rates do too much, but that view will be expressed in the dollar. And I just think it's interesting that we're starting to see the dollar roll over, which then I think obviously has massive implications in terms of obviously high beta risk should start to perform. NASDAQ, which is massively underperformed, should start to perform, and obviously the highest beta being that of crypto. And also it makes me, if we're pricing in this sort of peak inflation narrative, which we are, and we had obviously the first kind of rollover on the inflation last month. We're actually seeing even data in Europe today suggesting that inflation here has peaked as well. So we're kind of pricing this peak inflation, and it's still sticky and still probably uncomfortably high. But we're past that peak inflation hump. We're seeing growth sort of slow down, certainly the activity indicators pointing to slowing growth. So then that should start to be good for bonds. And I say we're seeing long duration start to perform. We're seeing 10-year yields and 30-year yields come lower. And crypto for me, again, is a high beta long duration asset. So if we think long duration is going to start to really perform here, which I think it will with the slowing growth, peak inflation narrative, then I think we're going to start to see crypto potentially perform. Obviously, we've got some idiosyncratic issues right now with the implosion of FTX, and there's perhaps more liquidations and that process to run through. But I actually think the macros turn much more constructive, and always wary of calling a bottom in markets and particularly crypto. But I think we are seeing a significant shift that might mark the lows in risk assets generally.
So what's your one key takeaway from all of this, I guess?
I think my one key takeaway is the regime has shifted from pricing Fed hikes to now moving towards a Fed pause. And I think my takeaway from that is that we're going to see risk assets bottom here.
Cool.
It does always seem, though, like whenever we do have these risk asset rallies, because the market, it's happened a few times now. The market thinks that the Fed is going to get more and more dovish. And then Powell always comes out and says, market, hold your horses. We still are not even close to being out of the woods yet, which takes us even lower.
Yeah, that's true. And like he's speaking tonight, right? After we record this, and I fully expect him to do exactly that, Joe, and just say, he can't go soft on what they're doing now, and he certainly doesn't want markets to kind of loosen financial conditions too much ahead of him. But I kind of feel like he's not in control of that. In the same way that markets tightened way ahead before the Fed did, will also sort of loosen, and he's trying to kind of, again, slowly kind of land the plane, and wants to keep things pretty smooth. So I think he's going to talk hawkishly. But what's quite interesting to me, if I look at the last couple of Fed meetings or when he's spoken, and he has been pretty hawkish and aggressive, I expect the same later. But the impact of that's pretty short lived, because a lot of this stuff's priced in. We're priced in for peak terminal rates around 5%. So he's kind of talking like we're going there. We're not easing up yet, but we kind of go, we panic, we sell off, we knee jerk sell off. I expect that to happen today. But then very quickly we kind of go, okay, well, it's peaked. And actually, what's the new information? The new information is that the Fed is slowing down the pace of hikes, and they are moving towards that terminal rate, which is what 100 bips or so away. So I kind of think we're priced in for those scenarios. And then markets that think 6, 9, 12 months ahead of themselves then start to price more. What comes next? What comes after a pause? And typically a pause is followed by cuts. So then we need to start to reprice that cycle, and markets will get ahead of that.
Yeah, that makes sense. There's certainly a lot of talk going around in the Twitter sphere. If these recent events didn't happen, Bitcoin would be at 30,000, or around there. Ethereum would be, at 2,000. Like, I guess what's your view in terms of where the market would have been, given all the dovish talk, if this didn't happen? I mean, I know we're just speculating here.
Yeah, well, I mean, 100%. So I've been saying before the FTX implosion that picking up on this shift in the macro dynamic, and again, it's quite a subtle shift. And that's why the dollar breaking down is quite interesting to me, and I wanted to see us breaking those levels. And before the FTX blow up, crypto looked pretty bid, right? And yeah, I think Ethereum now, given if you see the rallies we've had in Nasdaq, S&P over the last month or so, in response to that shift in sort of macro dynamic, yeah, I think Ethereum probably would have been over 2,000 and been making some sort of new highs there for the year, or certainly since the summer. And yeah, I don't know, Bitcoin at 28,000, 30,000. I think that's probably where we would have been heading. So obviously we've had to deal with this huge liquidity event. But one thing I do think is interesting, Joe, is I mean, God, like if you look at what's gone on this year from the sort of sharpest tightening cycle in recorded history. B, lunar blow ups. 3 arrows. Celsius, now FTX. A war in Russia and Ukraine. That I can't think of a worse sort of macro backdrop. And yet here we are, that's 17,000 or wherever we are in Bitcoin now. So I'm actually pretty encouraged by the resilience, and particularly as well Ethereum over the way that's trading over the last weeks. I think there's a lot of resilience there, and you kind of go, I mean, you don't want to give it the kiss of death, but what's the next bit of bad news that comes out? Now, yeah, there's going to be more dead bodies, and we expect that, but wow, we've survived a lot of bad news.
Yeah. It literally could not be worse. I want to say that, but then it'll probably actually get worse. But we've had like 7 or 8 like almost black swan events happen in a row in the span of like, a couple months, and then we're still here. Actually, I was talking with someone about that yesterday. I was like, man, it could not be worse. And yet Bitcoin and ETH, like you just said, have remained like somewhat resilient, right? So with all that in mind, Joe, can you like walk us through flows and what you're seeing in markets right now?
Yeah, sure. So in terms of the crypto auction markets, there's certainly been a lot quieter since FTX event happened. And it's quite evident by the volumes that we've seen on Deribit. We've been right around $500 million combined across Bitcoin and Ethereum, since the market has calmed down after the event, which is quite low, relative to what it was beforehand. The microstructure of the crypto option markets as well has really changed quite a bit since the event. And I do think that there's a fairly large imbalance between the number of market makers in crypto options and the number of real buy-side takers who are actively trading. So breaking that down, if I look at from a market maker perspective, there are a lot of firms that have cut back on their risk taking and exposure to centralized exchanges. And a good handful of these firms definitely took significant losses in their Delta One market making arms. And that, of course, reduces the risk appetite on the option side. But that being said, most of the option market makers that are on Paradigm are still participating in some capacity, right? Not a lot of these guys have really shut off the lights. Sure, they're hurting, they're licking their wounds, but a lot of these guys have not shut off the lights. But then now I compare that to the taker side, right? And I'm sure David can speak a lot about it too. He's kind of the boots on the ground talking to a lot of these risk managers, but we've definitely seen reduced interest from real takers looking to add risk and actively trade. And to be clear, when I say a real taker, like I'm talking about a buy side client. I'm talking about a hedge fund. I'm talking about a family office, a high net worth individual. I'm not talking about a market maker that is acting as a taker to recycle risk that they previously facilitated. So, most of the trades from the buy side takers that we've seen since the FTX event have happened have been on the risk reduction side. It's not been adding new risk. And we can go over some of these flows in a little bit specifically, but it's very clear that a lot of strategies and a lot of funds have taken a step back and are remaining on the sidelines for now. So now we have this market microstructure that is very different than what it was even a few months ago. And sure, Luna, 3 arrows, that certainly wiped out some big takers, especially the systematic vol sellers who were quite prevalent in crypto. But we were seeing a ton of interest in trading upside ahead of the ETH merge from a variety of clients. There was a ton of taker interest even a few months ago, right? And now you fast forward to today, and now it feels like you have this larger supply of market makers that, as I mentioned, they're licking their wounds, but a lot of them are still there. But then you have real buy-side taker demand that has really only been limited to a couple counterparties that have been adding risk. So that's kind of the view on the microstructure.
So, again, what's the one takeaway here from you? Like, what do you see happening in the next couple months?
I think the main takeaway is that the supply demand picture between the number of market makers and the number of active takers adding risk has definitely shifted more towards the supply of makers and less demand for takers. And if I'm being perfectly honest, given recent events, like people are going to be sitting on their hands waiting to see what happens. There's still potentially a lot of bodies that have yet to rise to the surface here. We're not out of the woods yet. And I think a lot of these guys are going to be taking a step back. So I think this is kind of be the status quo for the foreseeable future.
Cool.
Yeah, it's tough. I mean, I mean, one of the things I'm hearing when I'm speaking to people is, I mean, right now, you know, like credit counterparty risk is you know, the number one priority and concern, right? You know, there's me trying to sort of talk about the macro and all these things and the opportunities it's presenting. You know, we put out the other week about, you know, it's like looking at the opportunities in call spreads, which looks quite attractive. And you don't get too much pushback on that. The pushback is, yeah, we want to know, you know, where the risks are from a counterparty and credit point of view. And we need to get our house in order to make sure that, you know, we feel sufficiently protected, however they're going to do that, be it through use of prime brokers or however they're doing that. So yeah, I think short term, until people get their heads around that and have more comfort in terms of sort of what risks they're taking from a counterparty credit risk side of things, yeah, it's going to keep volumes a little bit more muted.
Yeah. Do you?
Yeah, especially on the derivative side. But one thing that has been a really interesting shift has been the increasing interest in trading on the CME. So Paradigm in the month of November had the largest amount of volumes traded on CME since April 2021, right? So in terms of like just the history of Paradigm, this was before I had joined the firm, but throughout late 2020 and early 2021, we were quite active on CME. But then there was this sort of year period or so, you know, leading up into FTX where we weren't doing any CME volume. This isn't me saying that like CME volumes were not happening. They were just not happening on Paradigm. But then now FTX happens. You have all these counterparty concerns for centralized exchanges. And then you see a sort of a flight to quality, if you will, right? You know, the regulated exchanges that, you know, have been around for a while, that have a proven track record in other asset classes. So, you know, anecdotally, I was having a conversation with a customer yesterday. It's like, hey, what would it look like if we're trying to back all our risk off of Deribit and onto CME, right? Like conversations like that are very, very telling that people are looking for that counterparty assurance. And it's going to be interesting to see what happens on the over-the-counter side, right? So when you directly face a counterparty bilaterally over ISDA rather than facing an exchange, like, are we going to see a shift in the OTC markets to bilaterally trade only against the most reputable counterparties, right? I'm not going to name them here just for protection purposes, but like, you know, those market makers that have been active in equities and rates and have been trading all these different products bilaterally for 20, 30 years. Are we going to see a sort of flight to quality in the OTC market? And, you know, that's a question that, you know, I don't have the answer to yet. I mean, Justin might be a good idea. Eventually we get one of our customers on, you know, one of our big market makers that are active in the OTC side, and they can kind of opine on, you know, and we can hear what they think.
I agree. I think we should definitely do that. I was going to ask that question, like, where do you think flows go from here, given that, you know, people are worried about counterparty risk? And do you think that drives, you know, derivatives flow on DeFi?
It certainly could.
Or do you think that people are still like a little worried about DeFi, I guess, for lack of a better term?
We've seen DeFi flows like pick up like 50% or so, right? In the last, you know, they're up. Those volumes are up like huge in the last couple of weeks. So, and it's probably more in the spot side of things, but definitely flows are going that way.
I just see it from like an institutional perspective, and if I'm looking to dip my toes into the crypto derivative sphere, right? Like, I want to be able to have an experience that is quite similar to what I have already in kind of other asset classes, right? You know, you really need to become an expert on like smart contract risk. And there's all these other risks that you are adding to the equation when you go into DeFi. I just don't see it. This is my personal opinion, you know, where, you know, a traditional finance investment manager that is looking to make the jump into crypto immediately is like, okay, I'm going to go into DeFi and trade on this protocol.
Yeah, it's a couple steps in.
And then they've got to solve for like the KYC, AML issues, I guess, to access DeFi. Yeah. You know, so yeah, I think that's probably a bridge too far right now.
Yeah, it might take a couple of years. Okay, so like, I think, do you guys have any final thoughts before we kind of close this one out? I mean, we're already at the 20-minute mark, so.
Yeah, I mean, I guess I can talk a little bit more because, you know, I was kind of just talking more about microstructure in the market generally, kind of what actually has happened over the past week from like, you know, you talk about it from a parameter perspective and some of the flows that we're actually seeing, like getting more deep in the weeds there. But like we were looking yesterday. So Bitcoin's 7-day realized volatility as of last night was 32.5, right? Like that is absolutely insane. That is crazy to think about. Like, sure, you can make the argument market's quiet over, you know, you have the long weekend, you have Thanksgiving, US holidays. But if you told me that on the day FTX went down, that 7-day realized has still not hit the lowest value it would hit in the month of November, I would have said you're out of your mind, right? And realized vol has done a complete round trip, despite the fact that there's all this contagion concern still out in the market. And implied vols are now sub 60, right? Out to February. I mean, the implied vols coming lower makes sense because the realized has been absolutely terrible. And, you know, the vol risk premium, as in the difference between implied and realized, has been rising every day. And, you know, that melt lower makes sense. But like the question is, where is the new floor in vol going to be? You know, because there's all these bodies that perhaps have yet to, you know, rise to the surface. Like, there has to be more skeletons in the closet here. I mean, look, maybe I'm a glass half empty guy. I know David thinks it's the bottom, but like, you know, maybe I'm being a little bit more pessimistic, but it's just crazy at the lack of like spot action that we've had in light of these recent events. And we've seen some guys even yesterday, like we had a big December strangle buyer, you know, some guy just, the December 12,000, 21,000 strangle, that was bought 400 times on us, right? And with such tepid realized, trades like that are going to get painful pretty quickly, right?
So, I think though, Joe, I think that partly speaks to the fact that, you know, a lot of the actual sort of deleveraging process ran its course in the summer. Like post the sort of lunar blow up and the things that followed that. So I actually think that's perhaps why the actual spot price action has been pretty muted, all things considered. I think we've seen that deleveraging. Also, let's not forget as well, FTX was a good place to be able to short and to actually sort of short via perps and with the margining there. So it's probably a little bit more difficult for people to put on those shorts. So we've got a market that's kind of delevered throughout the summer. And then, you know, those that would want to take sort of more of that directional risk and short the market, it's probably a bit more difficult to do so, as well as kind of thinking about the counterparty risk at this stage and the caution around that.
Yeah. Joe, when was the last time vols were this low? Do you know?
November 2nd. Well, 7-day realized. I mean, before FTX, of course. But, you know, the point is, like, you have this crazy systemic event, and in less than 3 weeks, the vols are back to where they were before it happened. Yeah. Right? Like, typically, you know, that mean reversion process, you know, takes a while. And sure, like, I'm 7-day realized, maybe I'm looking at too small of a window here, you know, given the holidays. But, like, the fact that we went from moving a ton to moving like basically nothing at all in the span of like 2 or 3 weeks, and there's still so much potentially in flux around, like the whole like DCG situation, right? It's just very surprising. Is my point.
It's quite funny when you think of all like the boomer no coiners who have, one of their things against sort of crypto and Bitcoin has been, the volatility, and the volatility is too high. I think it's been lower than it's been in the bond market this year. So,
well, it's nothing at all or all at once.
Yeah.
That's it, man.
Yeah, it's actually interesting looking at some of these equities too. Like they're trading like shit coins at this point. And so like, yeah, it's funny watching them like, oh, we don't like volatility in crypto, so we're not going to touch it. But now you look at some of the charts from like traditional markets and it's like, dude, they're just as bad.
Yeah, that's another interesting point is like the movement or the lack thereof of the movement in the coins versus like you look at crypto equities, right? I mean, look at the sell-off that Coinbase has had. Right. And then you have Armstrong coming in on Twitter and trying to, reassure the market. And I mean, look at Marathon Digital, they came in on their earnings call, like literally they reported earnings the day before FTX went down. And they said in their earnings report that we are budgeting, our mining business is budgeting for a Bitcoin price between like 18,000 and 21,000. Right. And then we started to sell off. And this thing went down 40% in the course of, a week and a half, right? And it just, you compare that to the resiliency that we've seen in the coins, and it's just crazy to me.
Yeah, people are just getting beaten up everywhere. Well, I think that's probably the show for this week. Would you agree? We can pick it up again next week?
Sure.
All right.
Yeah, cool.
That's it.